Letter of credit is one of the most common trade transaction methods. It is also known as documentary credit or credit. Hey everyone, you will get interest in this subject and we learn together how documentary credit works and it's binding on all parties. The International Chamber of Commerce (ICC) has formulated rules regarding documentary credit or letter of credit transactions, guiding the roles and responsibilities of the parties, relevant documents and circumstances. This publication is named as Uniform Customs and Practice for Documentary Credits or UCPDC, ICC publication number 600. Today, we are diving deep into a topic that is absolutely crucial for anyone involved in international trade. The letter of credit or documentary credit. It sounds complicated, but I promise by the end of this video, you'll understand it perfectly, the mechanism of letter of credit and other matters related to it. So grab a coffee and let's get started. Imagine you're an importer in the United States and you want to buy a large shipment of coffee beans from a supplier in Brazil. You've never met this supplier and they've never met you. How can you both trust each other? You're worried about sending a huge amount of money and not receiving the coffee. The supplier is worried about shipping all that coffee and not getting paid. This is the exact problem a letter of credit or LC is designed to solve. So what is a letter of credit? Simply put, it's a promise from a bank. Let's look at the formal definition of UCPDC 600. Credit means any arrangement, however named or described, that is irrevocable and thereby constitutes a definite undertaking of the issuing bank to honor a complying presentation. It's a formal document issued by your bank, the importer's bank, guaranteeing that the seller, the exporter, will receive payment as long as they meet specific conditions. These conditions are all written down in the LC itself. Essentially, the bank steps in as a trusted middleman, replacing the buyer's credit risk with its own. This gives both the buyer and the seller the confidence to do business with strangers halfway across the world. Think of it like this. The bank is saying to the Brazilian coffee seller, "Don't worry about the US buyer. As long as you ship the coffee and give us the correct documents to prove it, we will personally guarantee your payment." This assurance is what makes global trade possible on a massive scale. Now that we know what an LC is, let's walk through the entire cycle, step by step. It might seem like a lot of steps, but they follow a very logical sequence. Let's stick with our example of the US coffee importer and the Brazilian coffee exporter. Step 1 is the sales contract. Before any banks get involved, our US importer, let's call them buyer, and the Brazilian exporter, seller, negotiate the terms of their deal. They agree on the price, the quantity of coffee, the shipping method, the delivery date, and most importantly, they agree to use a letter of credit as the payment method. This agreement is formalized in a sales contract or a pro forma invoice. Step 2. The buyer applies for the letter of credit. With the sales contract in hand, the buyer goes to their own bank, which we'll call the issuing bank. They fill out an LC application form, detailing all the terms from the sales contract. This includes things like the seller's name and address, the amount of money, the shipping deadlines, and a very important list of required documents. The bank will review the buyer's creditworthiness, money laundering related issues, and all other regulatory and compliance issues, and if approved, will issue the letter of credit. Step 3. The issuing bank scrutinizes the terms and conditions of the contract or pro forma invoice, checks for its charges, required documents to issue the LC, etc. Then, after satisfying to issue the letter of credit, issue it through SWIFT by MT700 and sends the LC to the seller's bank. The buyer's bank in the US sends the official letter of credit document to a bank in Brazil that the seller works with. This bank is called the advising bank. The advising bank's job is simply to verify that the LC is authentic, finds no issues of regulatory or legal violations. and then pass it on or advise it to the seller. They're basically just a secure messenger at this stage. Step 4. The seller reviews the letter of credit. This is a critical step for the exporter. The seller receives the LC from their advising bank and must check every single detail. Does it match the sales contract exactly? Are the names and amounts correct? Can they realistically meet all the conditions, like the shipping date and the required documents? If there's even a tiny mistake, they must request an amendment immediately. If they accept a faulty LC, they risk not getting paid. Step 5. The seller ships the goods. Assuming the LC is perfect, the seller is now confident they will be paid. So they go ahead and prepare the coffee beans and ship them to the US buyer. When they hand over the goods to the shipping company, they receive a key document called the bill of lading. This document is proof of shipment and also acts as the title to the goods. Step 6. The seller presents the documents to their bank. Now the seller gathers all the documents required by the letter of credit. This typically includes the bill of lading, a commercial invoice, an insurance certificate, a certificate of origin, and a packing list. More other documents, if required by the LC, is also submitted with. They present this full set of documents to their bank, the advising bank. At this point, the advising bank might also act as a nominating bank, meaning it's authorized to check the documents and make the payment. Also, the nominated bank may be a bank other than the advising bank. Step 7. The documents are checked for compliance. The nominating bank meticulously examines the documents. Every single document must comply strictly with the terms listed in the letter of credit, in alignment of the rules of UCPDC 600 and the International Standard Banking Practices. This is called the principle of strict compliance. If there are any discrepancies, like a typo or a missing signature, the bank can refuse to pay. If there is found any discrepancy, banks must notify according to the instruction of Article 14 of UCPDC 600. If there is any confirming bank in the middle, the nominated bank must send the complying presentation to the confirming bank, and the confirming bank will also exercise its due diligence according to the instructions of ICC Publication Number 600 and International Standard Banking Practices ISBP. Also, the nominated bank may be the confirming bank, the nominated, and or the confirming bank sends the documents to the issuing bank for fulfilling its undertaking. This is why Step 4, reviewing the LC, is so important for the seller. Step 8, payment to the seller. If the documents are compliant, the magic happens for the seller. The bank pays them. The nominating or the confirming bank will either pay the seller immediately and then get reimbursed by the issuing bank, or they will forward the documents to the issuing bank for payment. Either way, the seller has their money. Even before the coffee beans have reached the US, they are happy and secure. Step 9. The documents are sent to the issuing bank. The Brazilian bank forwards the compliant documents to the buyer's bank, the issuing bank in the US. The issuing bank performs its own check to ensure everything is in order. Step 10. The buyer pays the issuing bank. Once the issuing bank is satisfied with the documents, it notifies the buyer. The buyer now has to pay their bank the amount of the LC. In return for the payment, the bank gives the buyer the shipping documents, including that all-important bill of lading and certificates as well. Step 11. The buyer claims the goods. The buyer now has the bill of lading, which is the title to the goods. They take this document to the port, present it to the shipping company, and can finally claim their shipment of coffee beans. The buyer is happy because they only had to pay after receiving proof that their goods were shipped correctly, and that completes the cycle. To recap, the buyer and seller agree on a deal. The buyer's bank issues an LC. The seller ships the goods after receiving the LC. The seller presents documents to their bank to prove shipment. The seller gets paid. The buyer pays their bank to get the documents. And finally, the buyer uses the documents to get their goods. The letter of credit creates a secure win-win situation. The seller gets a guarantee of payment, and the buyer gets a guarantee that they will only pay when the terms of the deal are met. It builds a bridge of trust over geographical and commercial distances, making it one of the most reliable payment methods in international trade. I know that was a lot of information, but hopefully breaking it down step by step made it clear. The letter of credit is a powerful tool, and understanding how it works is essential for anyone looking to expand their business globally. There may be more discussions on each individual party, documents, or the authority related to the letter of credit. We will separately discuss all these in separate presentations. Thank you so much for watching. If you found this video helpful, please give it a thumbs up and don't forget to subscribe to the channel for more content on trade, finance, and business. If you have any questions, drop them in the comments below. I'll do my best to answer them. See you in the next video of new learning subject. Thank you.